Hey guys, my name is Michael Manatskanian, and just to make sure there's no questions or confusion, it is here phonetically. So Michael Manatskanian, Manatskanian, okay? And my experience with real estate, I own a few properties up here in Fairbanks, Alaska. I analyze most of the multifamily properties that hit the market. My investment strategy is I buy and hold properties, and then I rent them out with the goal of trying to make some cash flow. And we're going to go over all of that. I've recently started sending letters directly to homeowners and doing some off-market deal finding, where I'm directly, working with homeowners and trying to get creative with our financing and purchasing of their properties. And as of August 1st, I will host my first Airbnb. So I'm really looking forward to doing that and having fun with that type of experience. So first and foremost, I want to put this out there. This comes with the more properties you analyze, especially properties on the on the MLS. The more you analyze, the more you'll see that most properties for sale are not good investments. I'm not saying you can't make some money off them. I'm not saying you can't offset some of your mortgage with a multifamily property, but as an investment property alone, they are not a good investment. And this is just a shot from the movie The Money Pit. It's not exactly what we're referring to here, but you never want to be putting in more money than you're actually making in a property. And not only do you want to at least break even, you want to definitely make sure that you're making an actual reasonable amount of return on your investment. So we'll kind of go over what that means moving forward. So how can you make money in real estate? There are 4 different ways to make money in real estate, and we'll break them down. Yeah. So first is appreciation. This is the most common one that you're probably familiar with. You buy a property for $200,000. 10 years later, it appreciates to the value of $300,000. It's a supply and demand thing, and sometimes that's offset by inflation, but that's besides this point. The idea is your property increases in value over time, and that's one way to technically make money in real estate, and that's appreciation. So second is debt pay down. So you're increasing the equity that you own in that property, especially if you're long-term renting it out, because your tenant is paying down your loan. So that is as reducing your loan amount, and you're not the one actually paying it. Your tenant is paying that for you. So that's one way. That's another method of making money. I mean, quote unquote, making money in real estate. Both appreciation and debt pay down are not necessarily as tangible unless you do creative strategies like refinancing, cash out refinancing, selling your property, taking out a HELOC, but there are definitely ways that you're gaining, increasing your net worth, even though you're not putting money in your hand at the moment. Then there are the tax benefits of real estate. There are lots of tax related deductions as a real estate investor. And a really, really big one is depreciation. I'm not going to be going into that at all, but that's just another benefit making money in real estate, because you're offsetting a lot of the income taxes you theoretically otherwise would be paying. And the one we're going to focus on today is cash flow. So cash flow is the leftover income after you so the rental income after you pay your monthly loan amount, any expenses, as well as set aside reserves. And this will be broken down much more as we move forward. But the key here is your income minus your monthly expenses and setting aside reserves. You want to make sure that you're setting aside reserves for your properties. And we'll break down what that means moving forward. All right, so there's a couple different investing strategies. The list I'm going to provide is not all inclusive, but these are some of the more common investing strategies. The one we're going to focus on today is buy and hold rentals. So you're purchasing a property and you're expecting a certain return after all your expenses, which is your cash flow, and each and every month. So you're putting a little bit of money in your pocket, you're getting the debt pay down, hopefully appreciation over time. Your primary focus is that monthly cash flow that you get, and that just continues to grow, and you can use that money towards other investments. There's the fix and flip, where your goal is to buy a property, then you renovate it, and then you sell it for a higher amount. Typically for this, you want to ensure that the purchase price of the property, as well as the renovation costs, are no more than 75 to 80% of the sale value, so that you're actually making some money, that you're actually making enough money for the time that you're investing into that. There's house hacking, and there's 2 options here. So the goal is to purchase a property, whether you're purchasing a multi-unit property, so a duplex, triplex, fourplex, and you rent out some of the units, or you can purchase a large single-family home and rent out the rooms. And in parallel with that is a live-in flip. So you purchase a property, you renovate it while you're living in it, and then if you live in there for 2 years, any gains that you get, any any appreciation that you get over by the time you sell it, you don't have to pay taxes on that. I mean, there's certain rules, but it helps offset a lot of the capital gains taxes. So just the idea is you can live in it, renovate it, and then either sell it or rent it, or live in it and then rent it out while you're living there. Okay, there's Burr, which is really popular in the bigger pockets forums. That's a very common strategy that you're hearing about now. I'm not sure how many investors actually do it all the time, but the concept is fairly straightforward on paper, but not as much on practice, because you have to be really effective at managing your systems to ensure you do it well. It's the Burr acronym is you buy a property, typically with cash, you rehab it or renovate it to increase the property value. You rent it out at at the highest rent you can get, and then you cash out, refinance the property typically to get all your initial money invested out, if not as much of it as possible out, if not all of it, and then you just continue repeating that cycle. This strategy is phenomenal in the sake of your cash on cash return, which we'll discuss moving forward, in the sense that you're investing very little money at the end of the deal into the property. Please look into that strategy if you'd like, but the better the returns typically, the more risk that's involved, and you just have to be really knowledgeable before you start something like that. Another one is short-term rentals. So either you buy a property and you rent it out on Airbnb or Vrbo, or you could also, there's rental arbitrage, where you basically rent out a property and then you short-term rent it out through Airbnb and Vrbo, but there's some legality aspects of that. So just make sure you know what you're doing when you get into that. All right, cool. As I mentioned, we're going to focus on buy and hold rentals, and we're primarily going to look at multifamily properties in here with the focus of cash flow and cash on cash analysis. So then how do we determine what's a good deal? As mentioned, there are two key metrics for analyzing buy and hold rental properties. First is cash flow, which restating is your income minus your fixed expenses minus your variable expenses. And we'll go over that. We'll break that down shortly. And the next metric that you want is your cash on cash return. Cash on cash return is your annual cash flow divided by your initial money invested. We'll break both of these down much further as we continue on. So let's break down cash flow. In this equation, your cash flow is your income, which is your rent plus fees, and we'll break down what are some other fees you can expect. There are your fixed expenses. These are the expenses you're going to be paying every single month, which include your mortgage, which is comprised of the principal on your loan plus interest, taxes, insurance, utilities if you cover them, and then property management is typically another one that most people do unless you're self-managed. And then you have your variable expenses, which are your reserves, and I save 18% of the total rent every month towards these reserves up until I hit a certain threshold. But that breaks down into your vacancy, which is basically anytime your property is sitting there without a renter in it, that's considered vacancy, and 8% equates to 1 month of vacancy per year. So you're just accounting for that 1 month of vacancy per year so that you're not the one caught holding the bag if you can't rent out your property in time. I definitely know people who have such great properties and great marketing that they have virtually 0% vacancy, and some that take a long time to rent out. It really depends on the condition of your property, your marketing ability, or your property manager. So, that one fluctuates, but 8% is a nice standard that people go for, 8 to 10%. And there's maintenance, which is comprised of any monthly repairs that you might have to do. For example, let's say there's a plumbing leak or lawn care or anything like that, just smaller, regular types of maintenance, which is typically 5% of your monthly rent. But obviously that depends on the condition of your property, as well as capital expenditures, which is another 5%. That basically are savings for big renovations that you might have to do. For example, replacing your roof, hot water heater, something along those lines. And you want to make sure you're saving for that throughout your time as an investor, so that you don't have to replace a $15,000 roof and then get screwed because you don't have that money saved somewhere. And we're going to break these down even further as we continue on with these slides. So income, as I mentioned, income is any and all monthly income, which includes your rent, pet fees, any laundry that you might have, vending machines, whatever is bringing you income. I've seen people do storage sheds. They charge 25 bucks a month, or carports. Some people account for their late fees in here. You could account for it as income, but I definitely wouldn't put that as part of your investing strategy. Hopefully your tenants are never paying late, and hopefully your investment doesn't bank on your tenants not paying in time. That's just bad from the start. And then a good way to estimate your income or rent is using resources like Rentometer. But it's really up to you to do your due diligence about those rental values. Sometimes when a property owner tries to sell their property, they'll list their current rents, but it's up to you to know what is actually a realistic rent. And typically, if someone's been holding a property for longer, they're probably a little bit under the current fair market rent. So it's really up to you to understand your market and know what each types of property rents for. And this is my fourplex. This one's a little different. Typically, you'd have a little bit more standardized, but the nicest unit rents for $1,350. We have 2 units that rent for $1,300 because they're downstairs units, so they rent for a little less. And then we have one that rents for $1,250 because this tenant gets a discount because they help with cleaning and other maintenance issues. So it's just a kind of agreement we made. And then there's actually $11 a month I estimate for laundry between each tenant. And what I've learned is this is insanely low relative to what I'm actually getting. I've already hit over 50, I think, over 50 bucks this month. And we're not even, and we're just barely past halfway through the month. So, you want to be very realistic with your numbers, especially when you go in. So this is probably the easiest is income, especially if you understand your market, and there's a lot of useful tools out there for it. So now let's break down your fixed expenses. So one of the expenses that will be paid or so on a monthly basis. And first and foremost is your mortgage payment. It's pretty easy. You can use any mortgage calculator online. This is highly variable depending on what your down payment's going to be, the purchase price, the interest rate, the loan term, but it's all very easily. This is probably the easiest part to figure out. Then next is property taxes. You can look at Zillow for a good estimate for what the property was recently paying in property taxes. And you can estimate something similar to that. In my calculator, I do it based off, I know what our county charges for property based off the assessed value. So I kind of use the purchase price as the assessed value. But the easiest way is to use what Zillow recently has and maybe increase it a bit. Insurance. So you have to get familiar with insurance agents to kind of understand what the typical insurance cost is for a single family duplex, triplex, fourplex, but that also depends on how much the property is worth. But after a while, you kind of get the hang of it, and you're always fine to estimate around 100 to 150 depending on the property cost and size. Mortgage insurance. This is pretty unique. This is primarily if you're trying to house hack and paying less than the 20% down payment required. If you're doing less than the 20% required, the bank sees you as a little more risky. So then they charge you a monthly insurance cost on your mortgage. So this won't really be applicable for what we're going to do moving forward. And you'll see that moving forward when we do a couple examples. As long as you're putting your 25% down and you're non-owner occupying it, there's no concerns about mortgage insurance. It'll be zero for you. And then the 3 in red, I approximate based off duplex, triplex, fourplex. It varies. Initially, when I'm analyzing a property, what the costs are going to be. In Fairbanks, it is very common for multifamily properties for the owner to cover water and sewer as well as heat and garbage. So it's very important to be able to approximate that, because that $600-700+ that you're not accounting for can really ruin any deal. So it's really important to account for that. And it's really important to understand what is normal for your market. You don't want to be the only person that's not offering those utilities covered if the norm is that, that's what you're doing. You want to try to minimize the variance between you and other properties as much as possible. Okay, and then electricity. So typically, I personally get properties that do not have, or that have multiple meters. So each tenant has their own meter. So I'm not covering anyone's electric. That's much more common, but there's typically a common room which has, your mechanical room, your boiler, your water heater, maybe laundry room, all that stuff that you should account for, because that $80 in this example would make a big difference. And then the other fixed monthly expense you should always account for is management. I self-manage all my properties currently, but I don't think it's realistic to expect yourself to self-manage all your properties as you continue to scale indefinitely. So it's really important to make sure that your deals make sense with a property manager accounted for. And that's typically 10% of the monthly rent goes to property management. Okay, so I'm going to move forward to variable expenses. So these are funds that will be saved on a monthly basis. These are not costs that you're paying every month, but these are a portion of your rent that should be set aside every single month. As we mentioned, I use 8% for vacancy, 8% of the rent for vacancy, 5% of the rent for maintenance, and 5% of the rent for capital expenditures. And these are things you should have savings for all the time. This is really important to save for. You can, when you analyze, and we'll talk about that further, you can analyze you should analyze your property accounting for these reserves as expenses. And we'll break that down on the next slide. But it's really important because, as I mentioned, you're not always going to have $10,000, $15,000 just sitting there. You want to make sure you're saving for that. And then at a certain point, maybe it doesn't make sense to keep, let's say you build up 20,000, maybe you only need 10,000. You can make up the other, amount that you need to, but you need to have at least some significant reserves for each property that you have. Okay, so in this example, let's actually run the cash flow now. We went through a ton of terms, a ton of numbers, but let's actually see it broken down here. So in this cash flow example, once again, it's your income or your rent minus your fixed expenses minus your reserves. So your rental income here was $52.42. Your mortgage is $1391.82. It's common that you separate your mortgage from your other expenses, and so that's why I have it here. The monthly expenses was $21.67. The reserves were $944. So on this fourplex, the cash flow shown here is $740 a month. That is great. My goal is, well, actually, we'll talk about what I look for in a property, but even further, we'll talk about how to actually compare apples to apples of what that means, because cash flow alone is not a sufficient metric because you want to make sure that the money you invest is working hard for you. So if you're cash flowing 100 a month, that's great, but it really makes a huge difference if you had to invest $10,000 to get that $100 a month versus if you had to invest $100,000 to get that $100 a month. So that's where cash on cash return comes into play. It standardizes and gives you the actual return on your investment. So let's break that down. It's very similar to return on investment, a term most of you have probably heard, but return on investment is more commonly used when you're referring to basically your net worth growth. So it accounts for appreciation, debt pay down, all that. Cash on cash return doesn't necessarily account for that. It focuses primarily on the cash flow versus the amount you invested. So what is cash on cash return? As we mentioned, cash on cash return is the annual cash flow. So your monthly cash flow times 12 divided by the initial money you invested. All right, so let's break that down. The initial money you invested is your down payment. So for this example, for a $100,000 house, your down payment of 25% is $25,000. Any loan closing costs, which varies between 2.5 to 3.5% roughly, so another $2,500, and any upfront rent-ready repair costs. So what that means is if you buy a property and it's turnkey, which means you can rent it out the next day or it's already rented, you're going to have no upfront rent-ready repair costs. But if you need to replace the carpets, do some painting, that all should be accounted for in your initial money invested, because you can't start making money off that property until you do those renovations. And we'll look at what all this looks like in an actual example moving forward. And I'm going to run you through 2 properties that I analyzed within the last few months. So once again, cash on cash return tells you how hard your money is working. And the higher the cash on cash return, the better the deal. The typical situation is higher cash on cash return markets typically don't have as much appreciation. That's just something you commonly see. So for example, in Fairbanks, where we don't necessarily have much appreciation, we pretty much are in line with inflation. You get you get an opportunity for fairly good cash on cash return. And this is also common in Midwest cities and areas like that. Whereas some places you get very high appreciation and you get virtually no cash on cash return. For example, let's think of Los Angeles or San Francisco, but the appreciation can be so high that it negates the cash on cash return. So it really depends on how you're analyzing your investment, and everyone's got different goals. The thing I look for is a certain standard of cash on cash return, or a certain amount of cash flow, and it needs to hit a certain cash on cash return. And I'll break that down what I'm looking for. So what is a good cash on cash return? So here's a little table. Basically, there's various standards, and this kind of breaks down what this means. So if you invest $100,000, an 8% cash on cash return means that you returned $8,000 for that year. That doesn't, that's a lot of, I guess it's a lot of numbers for the time being, but that means if you got that 8% cash on cash return, it would take you 12 and a half years to pay back that initial investment. Once again, that doesn't account for all the debt payment benefits you're getting, all the tax benefits you're getting, and all the appreciation benefits you might be getting. But from a cash flow perspective, getting your money back in 12 and a half years isn't too bad. I mean, that's a pretty good return. People, that's, a lot of what people are looking for. Another common one people look for is 12%. That's something you commonly hear. Something between 8 to 12% is what people are looking for, but that's highly variable on your market, and we'll kind of discuss that moving forward. And just to put things into perspective, if you have a cash on cash return of 50%, so for in this example, you get $50,000 of cash flow a year on this $100,000 investment, it'll take you 2 years to pay that back. So it just kind of shows you some various examples of cash on cash return relative to payback periods. And we'll actually go through what I look for and how you should determine what is good for you. So what return should you look for? As I mentioned, that's 100% up to you, and it's very dependent on each market. As I mentioned, some are much more appreciation markets, and some are much more cash flow or cash on cash return markets. However, what I always look for, there's a minimum standard that I personally look for. As I mentioned, this is completely up to you, but this is what I personally look for. I want cash flow of over $100 per unit. So if it's a single family home, I want over $100 a month in cash flow. And if it's a fourplex, I want $400 a month in cash flow, or 100 per unit at minimum. And more important to me than cash flow is you want a cash on cash return of over 10% at minimum. And I'll explain my reasoning for that. But you need to be a little bit logical about what this means. So if I invest $1 and I get 100% cash on cash return, that means I invested $1 and that means I got $1 back for cash flow. Is it worth any work to do it for such a minimal cash flow? No. So you can't look at one of these standalone. You kind of have to use them together. You want to make sure that you're getting a decent enough cash flow and your cash to cash return makes sense. So once again, this is what I look for. And the reason why, just to put everything into perspective, is the annualized all-time return of investing your money into the index fund, the S&P 500, is around 9.8%. So if I'm going to invest my time into real estate investing, I want to get at least the same return, at least the same cash on cash return. And then I get the benefits of all the other three ways to make money in real estate. So appreciation, tax deductions, and debt pay down. So I want to make sure if I'm investing my time, it takes me no time at all to automate my investments into the stock market. It's automatic. Every week a certain amount goes in. That's so easy. Real estate takes time, especially when you're trying to acquire the property. So you want to make sure that you're actually making that time worthwhile.